What is happening, crypto enthusiasts? Get ready to dive headfirst into the electrifying world of digital assets because the news cycle is moving at warp speed, and you absolutely cannot afford to miss these groundbreaking updates. We've got monumental shifts, surprising performances, and strategic moves that are redefining the game. From massive accumulations to unexpected outperformances, today's Bitcoin Bulletin is packed with insights that will keep you on the edge of your seat. You think you know what's next? Think again. We're breaking down the stories that matter, the ones that are shaping the future of finance right before our eyes. Let's get into it. First up, we're dissecting the incredible strategy of MARA Holdings, a titan in the North American Bitcoin mining scene. They're not just mining, they're accumulating, holding onto their mined Bitcoin with a firm belief in its long-term value. But what does this HODL strategy really mean for the market, and what are the hidden risks they're navigating? And speaking of outperforming, get ready for a surprise. Our next segment dives into why BlockDAG is not just keeping pace, but actually outperforming the mighty Bitcoin in early 2025. How is this challenger making such waves, and what does its rapid ascent signal for the broader crypto ecosystem? You won't want to miss these insights. Then, we shift our focus to the institutional giants. We're talking about the massive Bitcoin holdings of IBIT and what this signifies as a major validation play in the market. What does this influx of institutional capital truly mean for Bitcoin's journey and its place in the global financial landscape? Finally, we're bringing together the titans, Bitcoin and Ethereum. We'll explore how these two giants are navigating the choppy waters of volatility while simultaneously being targets of intense institutional accumulation. It's a complex dance of risk and reward. Don't just follow the market, understand it. Let's get into it. Make sure you're subscribed and the notification bell is on so you never miss a beat. MARA Holdings, the master accumulator. This North American Bitcoin mining powerhouse, MARA Holdings, also known as Marathon Digital Holdings, is executing a remarkable strategy that's turning heads across the digital asset landscape. Beyond simply expanding its mining operations, MARA is making significant moves to bolster its digital asset portfolio, carving out a substantial niche in the competitive cryptocurrency space. What sets MARA apart is its distinctive approach, a resolute commitment to accumulating mined Bitcoin rather than liquidating it for operational needs. This HODL strategy is deeply rooted in a profound belief in Bitcoin's long-term value and its potential for significant price appreciation. By choosing to retain their mined Bitcoin, MARA aims to capitalize on future market movements. The core idea is that as Bitcoin's value increases over time, the eventual sale of these accumulated assets will unlock substantially greater returns. However, this bold strategy is not without its considerable risks. The inherent volatility of Bitcoin's price poses a significant threat. A large stash of Bitcoin, reportedly over 52,477 BTC as of August 2023, leaves MARA highly exposed to sharp downturns, which could severely impact its financial stability. Furthermore, the upcoming halving event in April 2024, which slashed block rewards from 6.25 to 3.125 BTC, directly affects miners' revenue. MARA will earn less unless the price of Bitcoin compensates, potentially squeezing profit margins. The increasing difficulty of mining, coupled with escalating energy costs, presents another major challenge. MARA's energy cost per Bitcoin reportedly exceeded $35,728 in Q1 2025, with total production costs potentially soaring past $70,000 per Bitcoin. This scenario could lead to substantial losses if Bitcoin prices fail to keep pace. Operational risks, such as take-or-pay energy contracts that constrain cash flow during price slumps, and broader geopolitical and regulatory uncertainties further compound these challenges. Despite these risks, MARA Holdings' strategy has a profound impact on Bitcoin's market liquidity. By consistently acquiring Bitcoin, both through mining and open market purchases, MARA effectively removes significant quantities from circulation. In fact, their holdings exceed those of the next 5 largest public miners combined. This reduction in available Bitcoin on exchanges could contribute to market stability or even drive upward price momentum, assuming demand remains robust. The implications extend beyond market dynamics. MARA's actions could accelerate the adoption of crypto payroll solutions among European small and medium-sized enterprises, SMEs. By reinforcing market legitimacy and liquidity, MARA signals strong institutional confidence in Bitcoin, potentially alleviating concerns for SMEs contemplating crypto adoption for payroll. Their strategic expansion in Europe, focusing on AI, blockchain, and energy-efficient infrastructure, aligns with EU objectives for sustainability and digital sovereignty, potentially fostering a more developed ecosystem for crypto-based financial services and simplifying crypto integration into treasury and payroll strategies. Moreover, MARA's influence might spur regulatory advancements that reduce compliance burdens, making it easier for SMEs to adopt crypto payroll solutions. MARA Holdings is strategically positioned for sustained growth, backed by a substantial Bitcoin reserve and continuous investment in mining infrastructure. Their unwavering commitment to holding Bitcoin underscores a long-term vision that could prove highly beneficial during future market upswings. Companies like MARA often serve as crucial indicators of institutional sentiment toward Bitcoin, and their accumulation strategy reinforces the narrative of Bitcoin as a robust store of value, likely boosting confidence among other market participants. Their August performance, marked by adding 208 BTC without selling any, showcases a clear strategy. Mine efficiently and accumulate strategically, sending a powerful message about the enduring value of digital assets. But is this accumulation strategy the only path to success? We're about to find out. Next, we're looking at a project that's not just competing, but truly outperforming Bitcoin itself in early 2025. BlockDAG's explosive ascent, outshining Bitcoin. In a stunning turn of events that has sent ripples through the cryptocurrency community, BlockDAG has emerged as a formidable contender, not just keeping pace, but significantly outperforming the market's benchmark, Bitcoin, in the early months of 2025. This unexpected surge in performance raises critical questions about the evolving landscape of digital assets and the potential for newer, innovative technologies to challenge established giants. BlockDAG's innovative architecture, which combines aspects of directed acyclic graphs, DAGs, with blockchain technology, appears to be the key driver behind its remarkable performance. Unlike traditional blockchains that process transactions sequentially, DAGs allow for parallel transaction processing, leading to significantly higher throughput and faster confirmation times. This technological advantage is crucial in a market where scalability and speed are paramount. Early reports suggest BlockDAG has achieved transaction speeds far exceeding those of Bitcoin, enabling a more fluid and efficient user experience, which is particularly attractive for applications requiring rapid microtransactions or high-volume trading. Furthermore, BlockDAG has implemented a unique consensus mechanism that, while still under intense scrutiny and development, seems to offer a more energy-efficient alternative to Bitcoin's proof-of-work system. This focus on sustainability and reduced environmental impact aligns with growing global concerns about the energy consumption of cryptocurrencies, potentially attracting a more environmentally conscious investor base and a wider range of institutional interest. The project's roadmap also includes aggressive development in areas like smart contract functionality and decentralized applications, DApps, aiming to build a robust ecosystem that can compete with and potentially surpass existing platforms. The pre-sale success of BlockDAG has been nothing short of spectacular, raising substantial capital and demonstrating strong market confidence even before its full potential is realized. This early financial backing has allowed the development team to accelerate their progress, focusing on key milestones such as mainnet launch and exchange listings. The project's tokenomics have also been designed to incentivize early adoption and long-term holding, with strategic token burns and staking rewards aimed at managing supply and driving demand. The market's reaction to BlockDAG's performance has been a mix of excitement and cautious optimism. Analysts are closely watching to see if BlockDAG can maintain its momentum and deliver on its ambitious promises. While Bitcoin remains the undisputed king in terms of market capitalization and established infrastructure, BlockDAG's rapid ascent highlights the potential for disruptive technologies to capture significant market share. The success of BlockDAG could signal a broader trend where newer, more scalable, and potentially more sustainable blockchain solutions begin to gain traction, challenging the dominance of older, more established cryptocurrencies. Can this momentum continue, or is it a temporary surge? Meanwhile, the institutional world is making its own powerful statements about Bitcoin's future. IBIT's Bitcoin Bonanza, institutional validation enters full swing. In a significant development that underscores the growing acceptance of digital assets within traditional finance, the iShares Bitcoin Trust, IBIT, has rapidly amassed an unprecedented amount of Bitcoin, signaling a powerful wave of institutional adoption and market validation. This accumulation by IBIT, a flagship product from BlackRock, represents a pivotal moment, not just for the ETF itself, but for Bitcoin's trajectory as a recognized asset class. The sheer scale of Bitcoin holdings within IBIT is staggering. Since its launch, the trust has become a magnet for institutional capital, drawing billions of dollars from asset managers, pension funds, and other large financial entities. This influx is a direct consequence of the approval of spot Bitcoin ETFs in the United States, a regulatory milestone that opened the floodgates for traditional investors previously hesitant to gain direct exposure to cryptocurrencies due to custodial risks, regulatory uncertainty, or internal compliance hurdles. IBIT, being one of the largest and most prominent of these ETFs, has been the primary beneficiary, effectively acting as a massive conduit for institutional money flowing into the Bitcoin market. This institutional accumulation through IBIT serves as a powerful validation play for Bitcoin. For years, the narrative around Bitcoin has been debated. Is it a speculative asset, a store of value, or a legitimate investment? The massive inflows into IBIT suggest that a significant portion of the institutional world now views Bitcoin through the latter lens. These are not fleeting retail investors. These are sophisticated financial players deploying substantial capital based on strategic asset allocation models. Their participation lends credibility and stability to the market, potentially reducing the extreme volatility that has characterized Bitcoin in the past. The demand generated by IBIT and similar ETFs is creating a consistent, underlying bid for Bitcoin, which is crucial for its long-term price appreciation and adoption. Furthermore, the operational efficiency and accessibility offered by IBIT are key factors in its success. By providing a regulated, familiar investment vehicle, BlackRock has demystified Bitcoin for many institutions. Investors can now gain exposure to Bitcoin through their existing brokerage accounts, without the complexities of managing private keys, understanding different blockchain protocols, or worrying about exchange security. This ease of access is democratizing Bitcoin investment for a much broader and more powerful segment of the financial market. The consistent purchasing by IBIT also impacts Bitcoin's supply dynamics. As demand from the ETF grows, it puts upward pressure on the price, especially given Bitcoin's fixed supply schedule. This creates a positive feedback loop, potentially attracting even more institutional interest as the performance validates their investment thesis. The market's reaction has been overwhelmingly positive, with analysts pointing to IBIT's holdings as a key indicator of institutional sentiment. The consistent inflows are seen as a strong bullish signal, reinforcing the narrative that Bitcoin is maturing into a mainstream asset. While some caution remains regarding regulatory shifts and market fluctuations, the sheer volume of capital directed through IBIT suggests a fundamental shift in how Wall Street views and interacts with Bitcoin. But as institutions pile in, are the original giants feeling the heat? We're now turning our attention to how Bitcoin and Ethereum are navigating this very landscape of institutional accumulation and market volatility. Bitcoin and Ethereum, the institutional tug-of-war amidst volatility. The cryptocurrency market in early 2025 is a complex arena where established giants like Bitcoin and Ethereum are simultaneously grappling with intense price volatility and unprecedented levels of institutional accumulation. This dual dynamic creates a fascinating, albeit nerve-wracking, environment for investors, traders, and observers alike, highlighting the maturing, yet still unpredictable, nature of digital assets. Bitcoin, the original cryptocurrency, continues to be the primary magnet for institutional capital. The approval and subsequent success of spot Bitcoin ETFs, like BlackRock's IBIT, have opened the doors for massive inflows. These institutions are not just dabbling, they are deploying billions, seeking exposure to Bitcoin as a potential store of value or a hedge against inflation. This steady demand from large players provides a foundational support level for Bitcoin's price, acting as a buffer against some of the more extreme sell-offs. However, this institutional interest doesn't negate Bitcoin's inherent volatility. Market sentiment, macroeconomic factors, regulatory news, and even technical chart patterns can still trigger significant price swings. The interplay between consistent institutional buying and broader market sentiment creates a push-and-pull effect, leading to periods of sharp gains followed by rapid corrections. Ethereum, the second-largest cryptocurrency by market capitalization, is experiencing a similar, yet distinct, trend. While the anticipation surrounding a potential spot Ethereum ETF has fueled significant institutional interest and accumulation, Ethereum's price action is also influenced by its utility as the backbone of the decentralized finance, DeFi and non-fungible token (NFT) ecosystems. Institutional investors are increasingly recognizing Ethereum's value proposition beyond just being a digital asset. It's a platform for innovation. However, Ethereum also faces its own set of challenges, including network congestion during peak demand, the complexities of its ongoing transition to proof-of-stake, and evolving regulatory scrutiny. The volatility here is driven not only by market speculation, but also by the successful execution of its technological roadmap and the growth of its DApp ecosystem. Navigating this landscape requires a nuanced understanding. For Bitcoin, the narrative is increasingly about its role as digital gold and a potential inflation hedge, with institutional adoption serving as the primary driver of demand. For Ethereum, the story is more about its utility as a programmable asset and the platform for Web3, with institutional interest validating its technological advancements and ecosystem growth. Both assets are demonstrating resilience, absorbing significant market shocks while attracting substantial capital. This suggests a growing conviction among institutional players about the long-term viability of these cryptocurrencies, despite the short-term price turbulence. The broader market impact of this institutional accumulation is profound. It's lending legitimacy to the entire crypto space, attracting more sophisticated investors and potentially leading to greater market efficiency and reduced volatility over the long term. However, the sheer size of institutional positions means that their trading activities can have a magnified impact on prices, leading to concentrated risk. The community is watching closely, with analysts debating whether this sustained institutional demand can finally usher in an era of more predictable, albeit still dynamic, price discovery for these digital titans. And that wraps up our deep dives for today. But before you go, let's hit you with a rapid-fire recap of everything we covered. And that's a wrap on today's crypto roller coaster. We saw MARA Holdings doubling down on its HODL strategy, navigating risks with a long-term vision. BlockDAG is making waves, outperforming Bitcoin in early 2025 with its innovative tech. IBIT's massive Bitcoin accumulation is a huge win for institutional adoption, validating the digital asset space. And finally, Bitcoin and Ethereum are proving their mettle, balancing volatility with strong institutional demand. What an episode! If you found this valuable, smash that like button, subscribe for more essential crypto insights, and hit the notification bell so you're always in the know. Don't forget to share your thoughts in the comments below and follow us on all social platforms for real-time updates. See you next time.